Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Gogo Inc., GOGO, the in-flight connectivity powerhouse. And it looks like quite a story, a real high-wire act they're attempting.
Oh, absolutely. And right out of the gate, you need to understand the core thesis here. Gogo is a textbook, high-risk, high-reward proposition. The whole investment case hinges on this really aggressive technology transformation. They're promising, well, forecasting extreme financial outcomes, specifically an anticipated 67.4% expected earnings per share growth per annum over the next 3 years.
Okay, 67.4% EPS growth annually.
Yeah.
That's huge. That's definitely the reward side.
It is. But, and this is the crucial but, that potential is severely counterbalanced by an immense burden.
The risk factor.
Exactly. The risk is staring you in the face, a highly leveraged balance sheet. We're talking approximately $833.0 million in total debt as of the last filing.
$833 million.
Yeah. So this combination, the huge growth potential versus the massive debt, it means success depends entirely on flawless execution. Any misstep, any delay.
It gets magnified instantly by that debt load.
Precisely. There's really no middle ground in this scenario. It either works spectacularly or it could get very difficult very fast.
Okay, let's unpack this journey then. Where did this high-stakes situation come from? We need to start with the strategic shift Gogo made. This isn't the company many people might remember from commercial flights, right?
Nah, at all. They made a decisive pivot. Their business now is exclusively focused on two premium markets, Business Aviation, or BA, and the military government sector, MIL-GV. They're out of the commercial airline game.
And the thinking behind that, why abandon the volume of commercial?
It's all about the customer profile and margins. By leaving that high-volume, lower-margin commercial space, they target customers BA and MIL-G who prioritize performance and reliability above almost anything else.
They need it to work, every time.
Every single time. And they demand superior speeds, consistent global coverage. Crucially, they are significantly less price-sensitive than your average commercial traveler or airline.
Which means Gogo can charge more.
Exactly. Premium pricing, which leads to much higher average revenue per user, or ARPU, and significantly stickier longer-term service contracts. These aren't customers who churn easily if the service is good.
That pivot sounds smart, but it wasn't simple. It required a major structural change, and the absolute centerpiece of that was the acquisition of Satcom Direct, or SD.
Yes, that deal closed in December 2024.
And it wasn't just about buying a competitor, was it? It was about capability.
It was absolutely a game changer. You can see that in the price tag, the preliminary fair value was estimated around $447.893 million. That's a huge investment.
Nearly $500 million.
Right. And it wasn't just about taking out a competitor, though it did that. SD instantly gave Gogo a global military and government footprint, critical access to NATO members, for instance.
So it was the key to unlocking that MIL-GV market globally.
Absolutely. Their stated goal post-acquisition is very clear: to become the only multi-orbit, multi-band flight connectivity provider purpose-built for BA and MIL-GV. SD provided the institutional know-how, the existing relationships, the global client base, to even attempt something that ambitious.
Okay, so they've got the strategy, the acquisition. What about the market itself? Is the demand there to justify this big bet?
Well, when you look at the market they're targeting, the global business aircraft market, the sheer scale of the opportunity becomes clear. It's fundamentally unpenetrated right now.
Unpenetrated. How much so?
The numbers are pretty stark. The global fleet is roughly 41,000 business aircraft, but only about 9,700 of those, just 24%, currently have broadband connectivity.
Only 24%? Wow.
Yeah, that leaves a staggering 76% of the market essentially untreated. These are aircraft with either slow, outdated legacy systems or maybe no broadband at all. It's an enormous white space for Gogo to chase.
And who's demanding this connectivity? Is it just corporate travelers needing email?
It used to be maybe more about productivity, but now it's driven by demographics. It's about expectations. Connectivity has shifted from being a nice-to-have perk to a fundamental expectation.
You mean younger generations just assume it'll be there?
Overwhelmingly so. The sources we looked at show that 98% of Gen Z and 87% of Gen YX demand Wi-Fi connectivity when they fly. 98%.
That's basically universal demand from the next generation of users and executives.
Exactly. So this transforms connectivity from, a discretionary spend into a core asset for anyone owning or operating a business jet. It essentially forces owners to upgrade their systems if they want to stay competitive, attract charter clients, or satisfy their own executives. This demographic pull is what really fuels the confidence behind those aggressive revenue forecasts.
Okay, so we have the strategic pivot, the big acquisition, a huge untapped market, and strong demand drivers. Let's see how this translated into actual performance recently. We've got the Q3 2025 financial snapshot. This is a key period right after that SD deal closed.
It is. And the top-line numbers, at first glance, look spectacular. Q3 revenue was reported at $223.59 million.
Okay.
And the really important part, the service revenue that's the recurring cash flow generator, it jumped a phenomenal 132.1% year over year, comparing Q3 2025 to Q3 2024.
132% increase in service revenue. That's almost entirely the SD acquisition effect, right?
Entirely. It shows the immediate top-line payoff of bringing Satcom Direct into the fold. Huge boost.
I see here the immediate bottom line was actually negative, a net loss. That seems odd with such a massive revenue spike.
It does sound alarming initially. The company reported a $1.9 million GAAP net loss for Q3 2025. Now, this is where we really need to dig into the accounting nuance.
Okay.
Because management frames this loss as highly exceptional, not indicative of the underlying business health. The primary driver was a substantial $15.0 million pre-tax fair value adjustment.
$15 million. Related to what?
Related specifically to the Satcom Direct earnout liability.
The earnout. So, potential future payments tied to SD's performance post-acquisition.
Exactly. So management essentially asks investors to look past this $15 million charge. They argue it's an integration expense, a non-cash accounting adjustment, not representative of core operations. They pull it out for their adjusted EBITDA calculation, for instance.
Okay, but how justifiable is that really? When you're looking at the risk, earnouts are real potential costs tied directly to the acquisition that's driving the revenue growth.
That is the critical question, isn't it? Well, it's technically a non-cash charge in that quarter, and management is correct to place it outside metrics like adjusted EBITDA. You can't just ignore it. It underscores that integrating a nearly $500 million business is expensive and complex.
Especially when you're already highly leveraged.
Precisely. Ignoring $15 million in integration-related costs is difficult when you have over $800 million in debt. It's a cost of growth, sure, but it also demonstrates that the financial risks tied to this big pivot are being realized almost immediately on the P&L.
And that leads us perfectly into the real elephant in the room, that financial leverage. Given those integration costs, the debt used for the SD deal, this is where the risk is absolutely concentrated, isn't it?
This is the heart of the bear case, no question. As of September 30, 2025, that total long-term debt stands at $833.0 million.
And what's that made up of?
It's primarily two big pieces. There's the $600.1 million 2021 term loan facility, and then the $243.6 million HPS term loan facility, which was the specific debt taken on for the SD acquisition.
Okay, nearly $1 billion in debt. How are they managing that load? What's the pressure look like on their operating profits?
We can look at a couple of key metrics here. First, their net leverage ratio. It was sitting at 3.1x in Q3 2025.
3.1 times net debt to adjusted EBITDA.
Right. Now, that is slightly down from 3.2x the previous quarter, which is a small positive, but it's still high. Management themselves have a long-term target range of 2.5x to 3.5x, so they're right in the thick of it. Not comfortably low yet.
Still feels high for a company needing flexibility.
It does. And second, look at the sheer cash burden of this debt. Year to date, for just the first 9 months of 2025, the cash interest paid was a staggering $59.3 million.
Almost $60 million just on interest payments.
Yeah.
In 9 months.
Yes. That is cash walking out the door before they invest a single dollar in new R&D, new antenna purchases, or anything else related to growth. It's a massive fixed cost.
So when you're paying out that much cash just for interest, your ability to actually cover that interest with your operating profit becomes absolutely crucial. You mentioned the coverage ratio is tight.
Exceptionally tight. Our source analysis indicates an EBIT to interest coverage ratio of just 2.6x.
2.6 times. Break that down. What does that mean practically?
It means Gogo's operating earnings, their EBIT, only cover their required interest payments 2.6 times over. Analysts looking at this rightly point out that this metric leaves very little margin for error.
So if anything goes wrong,
Exactly. If there's an unexpected operational hiccup, say the 5G launch gets pushed back by 6 months, or maybe those legal fees from the SmartSky lawsuit spike unexpectedly, that 2.6x coverage ratio could drop very quickly into the danger zone.
Raising real concerns about their ability to keep servicing the debt without needing more cash from somewhere.
Precisely. It highlights the fragility inherent in that high leverage.
And compounding that danger is the fact that a lot of this debt isn't fixed rate, right? And their protection against rate hikes is actually decreasing.
That's another key structural risk factor. Gogo uses interest rate caps to hedge some of their exposure to rising variable rates, specifically SOFR-based debt.
Okay, that sounds prudent.
It is, but the issue is the amount of debt being protected. The notional amount covered by these caps is stepping down over time. As of Q3 2025, the hedged amount was only $250 million.
Only $250 million out of $833 million total debt.
Right, it represents only about 30% of their total loans, and the strike rate on those caps is relatively low, 2.25%. So while that portion is protected, if rates go above 2.25%, it leaves the other chunk completely exposed.
How much is exposed?
That leaves approximately $583 million of their debt completely unhedged, directly exposed to movements in interest rates.
Okay, let's translate that exposure into a real threat. What happens if, say, SOFR climbs just 100 basis points, 1 percentage point? What does that mean for Gogo's cash flow?
That's an immediate, substantial hit to their cash flow. A 100 basis point rise on $583 million in unhedged debt translates directly to an extra $5.83 million in annual interest expense.
Almost $6 million more cash needed just because rates went up 1%.
Exactly. Cash that has to be diverted from somewhere else, probably from growth investments or debt paydown. And importantly, that extra expense would further squeeze that already tight 2.6x coverage ratio we just talked about. It really demonstrates how sensitive Gogo's financial health is to every single basis point move in interest rates right now.
Okay, so this high leverage, the tight coverage, the interest rate risk, it creates this immense pressure cooker timeline. When does this debt situation absolutely need to be resolved?
The main clock is ticking towards April 2028. That's when the big 2021 term loan facility matures.
April 2028. That's not that far away in terms of major corporate finance cycles.
It's really not. Management is under immense pressure, you can hear in their commentary, to achieve significant free cash flow, FCF, acceleration starting in 2026. That's the absolute priority.
And why is 2026 so critical?
Because that FCF is essential to delever the balance sheet. They need to get that net leverage ratio below the crucial 3.0x target, ideally closer to their 2.5x bottom-end goal. Only by demonstrating strong, sustainable cash generation and sharing progress on deleveraging can they hope to secure favorable refinancing terms as that 2028 deadline looms.
Yeah.
They basically have a critical 2-year window starting now to prove the growth thesis is working and generating cash.
A very tight window indeed. Now, assuming they do succeed, they navigate this, and they start generating significant profits. They have a potentially valuable asset waiting in the wings, right? These net operating losses or NOLs.
They do. It's another complex piece of the puzzle. Gogo holds approximately $363 million in federal NOLs.
And those can be used to shield future profits from taxes.
That's the idea. They're valuable because they can significantly reduce their cash tax payments once they become consistently profitable. However, even these valuable tax assets come with a potential catch.
There's always a catch. What is it here?
It's a subtle but important risk factor related to IRS rules, specifically Section 382, the ownership change rule.
Okay.
This rule basically states that if there's a cumulative shift of more than 50% of the company's stock ownership among its major shareholders, typically those holding 5% or more over a rolling 3-year period, then the annual amount of those NOLs Gogo can actually use could be severely limited.
So big shareholders trading large blocks of stock could accidentally trigger a limit on how much tax Gogo can save each year.
That's the risk. Given that ownership in Gogo is already quite concentrated among institutional investors, large block trades, new activist investors coming in, or even significant buying and selling amongst existing large holders could potentially trigger this technical limitation under Section 382.
And if that happens, what's the impact for someone trying to model Gogo's future value?
It means the modeled benefit of those $363 million in NOLs gets pushed out further into the future. The timeline for Gogo becoming a material cash taxpayer might accelerate, and the present value you assign to those tax assets decreases. It adds another layer of uncertainty to the long-term financial picture.
That's a fascinating complication, kind of hidden away in the tax structure.
Okay.
So we thoroughly defined the risk side of the equation, the massive debt, the razor-thin coverage, the shrinking hedge, the ticking refinance clock, even the NOL risk. Now let's pivot. Let's dive into the reward side, the technological growth potential that supposedly underpins that audacious 67.4% EPS growth forecast.
Right. This is where the bull case lives. The reward narrative really hinges on Gogo successfully capturing the massive opportunity created by their strategic pivot to BA and MILGV.
And the market opportunity is still huge.
As we said, 76% of the global business aviation market remains unpenetrated or using outdated tech. That's the prize. And the tailwinds supporting this penetration seem substantial. Global business jet flights are consistently running about 30% above pre-COVID levels. Demand for private aviation is strong.
And the manufacturers are busy?
Exactly. Strong OEM backlogs at places like Bombardier, Gulfstream, Dassault, that guarantees a future pipeline of new aircraft needing connectivity solutions. And don't forget that Gen Z demand 98% expect Wi-Fi. The pressure to equip is immense.
So this is clearly a market ripe for technological dominance. Gogo's strategy relies on what they call their hybrid moat. Can you explain that? How does blending their own tech with satellites create a real competitive edge?
The hybrid moat is really their key differentiator, especially for those high-end BA and critically the MILGV clients. Their strategy is built around a multi-orbit, multi-band network.
Multi-orbit, multi-band. Break that down.
Okay, so it seamlessly integrates their proprietary air-to-ground, or ATG network, which they built out, and is very effective over North America with access to traditional geostationary GEO satellites for broader coverage, and crucially, the new low Earth orbit LEO satellite constellation.
Like Starlink or OneWeb.
Exactly.
Yeah.
They access capacity on those LEO networks, and all of this ATGEO, GEO LEO, is managed through their unified plain simple antenna terminals on the aircraft. This integration gives customers unparalleled flexibility and, most importantly for certain clients, redundancy.
Redundancy. Why is that so vital, particularly for that military and government sector they're targeting?
Because it uniquely meets the strict military requirement for what's known as the PACE-E strategy. That stands for Primary, Alternate, Contingent, and Emergency Communications Planning. For a government or military user, connectivity isn't just about streaming Netflix or doing emails. It's potentially mission-critical, command and control, intelligence data, etc. If their primary link, say the GEO satellite, goes down due to weather, jamming, or malfunction, they must have an immediate automatic switchover to an alternate path LEO, or ATG if they're over land without any interruption.
Seamless instant failover.
Precisely. Gogo's integrated hybrid model is explicitly designed to deliver and sell this guarantee of survivability and resilience. That's a massive selling point for MILGV, and it's why they believe they can win major federal contracts that competitors using only a single network, like only LEO or only GEO, might struggle to secure.
Okay, that makes sense. Let's look at the pillars of that hybrid system, starting with the domestic piece, the Gogo 5G rollout. This seems like the nearest term revenue booster, right? Expected to start generating cash flow soon.
Yes, this is absolutely critical for hitting those near-term financial goals we talked about. They are essentially, as they put it, at the goal line with 5G. The ground network, consisting of 170 towers across the U.S. and southern Canada, is complete.
Network built. What about testing?
Flight testing began in late October 2025. Management reported that the initial results have actually exceeded their expectations for speed and reliability. So, the tech seems to be working well in the air.
And commercial launch. When do customers start paying?
Commercial launch is slated for Q4 2025, so very soon. This sets the stage for actual revenue generation, starting late in Q1 2026. Given that pressure cooker timeline towards the 2028 refinancing, hitting that Q1 2026 revenue start date is an absolutely critical milestone for them to meet. No room for slippage there.
And assuming they hit it, what kind of financial impact are they forecasting once 5G is operational and customers start upgrading from the older ATG systems?
The impact is expected to be transformative for their recurring service revenue. Gogo 5G promises speeds significantly higher than their legacy ATG. Think 50 to 80 megabits per second, potentially bursts even higher.
Much faster.
Mm-hmm.
And that translates to higher bills.
That's the projection. This jump in performance and capacity is forecast to drive ARPU, that average monthly connectivity service revenue per ATG aircraft online, that is potentially twice that of their current classic ATG users.
Double the revenue per plane, just from upgrading the speed.
That's the forecast. It's not just a 10% bump. They're banking on a doubling of connectivity revenue per aircraft. because higher speeds enable higher data consumption, video streaming, large file transfers, VPN use, which means customers will likely move to higher data plans.
And is the customer base ready for this? Are planes equipped?
They've been preparing for this. Gogo reports that around 400 aircraft are already pre-provisioned for the 5G service, meaning the wiring and basic infrastructure are in place, making the final upgrade much quicker and easier once the service launches.
Okay, so 5G is the near-term domestic catalyst. Now, let's talk about the global pillar. Gogo Galileo. This is their strategy using LEO satellite constellations, right? Accessed via those new electronically steered antennas.
That's right. Galileo is the global play, leveraging LEO for high-speed, low-latency connectivity anywhere in the world. And the momentum here seems to be accelerating dramatically, really validating that expensive Satcom Direct acquisition which brought the global customer base.
How's the pipeline looking for Galileo?
It's exploded recently. The combined sales pipeline for their two main LEO terminal types, HDX, which is half duplex, generally for smaller aircraft, and FDX, full duplex, for larger jets and government clients, it's now recorded at 1,000 opportunities globally.
1,000. That sounds like a big jump.
It is. It doubled from the 500 opportunities they reported just at the end of Q2 2025. Seeing that kind of pipeline growth, doubling just one quarter, suggests the market is rapidly waking up to the promise of LEO connectivity for business aviation, and that Gogo is capturing a lot of that interest.
1,000 potential installations globally. That represents huge potential revenue, but it also requires immense capital commitment from Gogo, right, to actually build and supply those antennas.
Absolutely. The performance expectations for Galileo are extremely high. They're citing speeds up to 195 Mbps in their materials for FDX HDX, combined with that ultra-low latency that LEO provides, making things like real-time video conferencing finally seamless in the air. That's a must-have now.
And the investment needed.
To meet this escalating demand pipeline, Gogo has stated they've already secured commitments totaling over $250 million. That's over $250 million in required antenna purchases for these next-generation Galileo systems.
Wow, $250 million committed just for the hardware.
It's a massive investment, no doubt, but it demonstrates their confidence, perhaps necessity, given the plan in that long-term sales pipeline and their ability to convert those 1,000 opportunities and capture a big chunk of that 76% unpenetrated global market. They're betting big.
Okay, so on one side, we have this incredible technological ambition, the 5G rollout, the Galileo LE systems, huge market potential, and those aggressive 67.4% EPS growth targets. That's the reward. But as we know, that flawless execution needed to achieve it hinges on navigating some pretty major regulatory and legal headwinds. Let's start with the competitor litigation. That sounds nasty.
It does. The litigation coming from their competitor, SmartSky Systems, represents a really serious operational headwind and, frankly, a financial distraction right now. Gogo is currently defending against what looks like a multifaceted legal assault. It's complex, and it's certainly costly.
What are the main components of this legal battle?
Well, there's a major patent infringement trial specifically regarding Gogo's 5G technology. That trial is currently scheduled to begin on November 17, 2025, so that's imminent. The outcome there could obviously impact the 5G rollout.
A patent trial right when they're launching 5G. That's terrible timing.
Couldn't be worse. And beyond just the patent fight over 5G, there's another potentially much larger financial threat looming from SmartSky.
What's that?
That's the antitrust lawsuit. Gogo is facing a separate, potentially enormous $1 billion antitrust claim also brought by SmartSky.
$1 billion antitrust suit.
Yes. Now, whether that figure is realistic is another question, but defending against a suit of that scale requires substantial legal resources and management attention. In fact, the increased expense related to this litigation was specifically cited by Gogo as a cause for higher operating expenses in Q3 2025.
So it's already hitting their bottom line through higher OPEX.
Correct. And maybe just as critically, these intense legal fights divert valuable technical personnel, the very engineers you need, perfecting the 5G and Galileo rollouts, ironing out bugs, supporting customers. It pulls them away from core innovation roles to assist the legal defense, prepare depositions, analyze technical evidence. It's a massive drain on focus and resources at exactly the wrong time.
Okay, so major external legal battles. But the distractions, or maybe risks, aren't just external, are they? The rapid integration of that big Satcom Direct acquisition seems to have exposed some internal financial control weaknesses. That sounds concerning for anyone relying on their reported numbers.
It is, and this is a crucial governance risk point that investors need to be aware of. To their credit, management was transparent about this in their filings. They concluded that their disclosure controls and procedures were, in their words, not effective as of September 30, 2025.
Not effective. Why?
Due to identified material weaknesses in their internal control over financial reporting, specifically related to the SD integration, the identified flaws included ineffective GITCs. That's General Information Technology Controls.
GITCs. What are those in plain language?
Think of them as the basic IT housekeeping controls over system access, data backups, change management for software, fundamental stuff ensuring the integrity and reliability of the financial data flowing through their systems.
So if those basic IT controls are weak, what does that mean for an investor trying to trust the numbers we just discussed, the revenue jump, the net loss, etc.?
It means, and Gogo acknowledged this, that during the rapid integration of Satcom Direct, they didn't have sufficient controls over the completeness and accuracy of Satcom Direct's financial reporting information. In essence, they're saying the process for combining SD's numbers into Gogo's consolidated financials wasn't robust enough yet.
So there's an inherent risk the integrated numbers might contain errors.
That's what a material weakness implies. It means there's a reasonable possibility that a material misstatement of the financial statements would not be prevented or detected on a timely basis. Now, they emphasize that remediation efforts are underway, hiring new personnel, implementing stronger processes, but until these material weaknesses are fully remediated and tested, they definitely compromise the overall reliability and auditability of the integrated financial statements. It's a significant red flag, especially for more conservative investors.
Definitely something to watch closely in future filings.
Yeah.
Okay, one final operational headache that seems to speak directly to their cash flow situation and that leverage. This FCC reimbursement entanglement. What's going on there?
Yeah, this is essentially a capital mismatch situation. Gogo was approved for up to $334 million under the FCC's Rip and Replace program. This program mandates the removal of equipment from certain companies, like ZTE, from U.S. networks, and provides funding to cover the costs.
Okay, so $334 million approved sounds good. Free money to upgrade parts of their network.
That's the potential. This money is specifically designed to reimburse them for the capital expenditures required to replace that gear, primarily in their older network infrastructure. However, the problem is the timing of the cash. Through Q3 2025, they had only actually received $59.9 million in grant funding.
Only $60 million received out of $334 million approved. So they're having to spend the money up front to do the work, but the reimbursement checks are lagging way behind.
Precisely. The whole Rip and Replace project timeline is proving much longer and more complex than anyone initially expected, across the industry, not just for Gogo. This forces Gogo to front-load the capital expenditures themselves, using their own cash or drawing on credit lines.
Which, given the $833 million debt load and the tight cash flow we discussed, must put a significant strain on their working capital.
Absolutely. Having to wait on potentially $270 million or so in expected reimbursements adds yet another layer of pressure onto their liquidity situation and that crucial refinancing timeline. Management themselves indicated they're expecting additional extensions beyond the initial FCC deadlines, meaning this cash bottleneck probably won't be resolved quickly. It's another drag on near-term cash flow.
Okay, so legal battles, internal control weaknesses, cash flow, bottlenecks. Quite a few headwinds. Let's pull back again, though, and look at the strategic long-term volume driver that potentially makes navigating all these headaches worthwhile.
Yeah.
The expansion into that military and government, or MIL-GV sector.
Yes, this is arguably the most critical long-term revenue shift enabled by the Satcom Direct acquisition. The MIL-GV sector currently represents about 13% of Gogo's total revenue.
13% now. Where do they see that going?
Management has explicitly projected this segment moving towards 20% of total revenue over the longer term. This is a key part of diversifying their revenue base and improving overall margins.
Why is MIL-GV so attractive compared to even business aviation?
Well, the penetration rates in many government and military fleets are potentially even lower than in BA. Plus, these tend to be extremely reliable, high-margin contracts, often spanning multiple years. Governments value stability and performance above all else.
And success here really hinges on that multi-orbit hybrid strategy we talked about earlier, offering that pace redundancy.
Entirely. That's their unique selling proposition for this market. And we are seeing evidence that it's working. They're winning contracts that specifically validate this approach.
Like what? Any key wins?
Absolutely. The most significant one recently announced was a highly strategic 5-year federal contract with a major U.S. government agency. The contract is specifically to deliver a combination of 5G, LEO, and GEO services.
So the full multi-orbit package.
Exactly. And Gogo highlighted this contract marks the first service win for 5G in a multi-orbit government contract. This is massive validation. It proves that their integrated approach is not just theoretical. Government customers are actually buying it because it meets that critical need for guaranteed redundancy and survivability through pace. It shows they're willing to pay a premium for that capability.
That's a powerful proof point. Now, beyond the government sector, the key to scaling Galileo globally, especially in BA, is getting buy-in from the major aircraft manufacturers, the OEMs and the big fleet operators. Are they gaining traction there?
The market validation from the blue-chip fleet operators and OEMs looks extremely strong right now, which is encouraging. For instance, VistaJet, which is a leading global business jet operator with a huge fleet.
Right, they're everywhere.
They announced plans to deploy both the HDX and FDX LEO systems across their massive fleet of around 270 aircraft. That's an immediate, significant volume driver for Galileo hardware and service revenue once deployed.
207 aircraft from one operator. That's huge. What about the manufacturers getting systems installed at the factory?
That's arguably even more important for long-term entrenchment. And yes, they secured a major win there too. The Gogo Galileo FDX system, the higher-end one, was named as a selectable LEO line-fit option for all new Bombardier Challenger and global business aircraft types.
Line fit on new Bombardier jets.
Yeah.
It's basically the gold standard endorsement, isn't it?
It really is. Being named a line-fit option by a major OEM like Bombardier signifies the highest level of trust. It means the manufacturer is confident enough in Gogo's system performance, its reliability, and crucially, its long-term viability and support to integrate it directly into their brand new aircraft coming off the assembly line.
And that makes it much harder for competitors later on.
Absolutely. It creates a powerful commercial barrier to entry. Once an aircraft is built with the Gogo system integrated, it's much less likely to be replaced. These OEM wins are critical for cementing long-term market share.
Okay, incredible. We've covered the whole flight plan now, I think. The huge potential, the 67.4% EPS growth target driven by 5G and Galileo capturing that untapped market, but also the immense risk, the $833 million debt, the tight 2.6x coverage, the decreasing hedge, the 2028 deadline, plus the headwinds, the billion-dollar antitrust suit, the internal control issues, the FCC cash delays. So after digging through all of this, what does it all mean when you synthesize the risk and the reward? What's the final verdict here?
Look, it means Gogo is operating in the really rarefied era of high finance and high-stakes technology deployment right now. The verdict, I think, is crystal clear. Gogo is definitively, as we said at the start, a textbook, high-risk, high-reward investment proposition.
Well, middle ground.
Absolutely no middle ground. There is no scenario where you can look at this and call it a safe, conservative investment. They are absolutely performing on a high-wire act. Success could be spectacular, but the risks are equally large.
And the performance bar they need to clear to justify the current optimism, let alone hit that 67.4% growth, is just massive.
It is immense. The entire growth thesis and, critically, their ability to manage that huge leverage pile, it all depends on absolutely flawless execution over the next 2 to 3 years.
Flawless execution. That's a tall order.
It really is. They must convert those massive capital investments the 5G rollout needs to generate cash quickly. That $250 million committed to Galileo antennas needs to translate into installations and service revenue rapidly. They need to turn that spend into premium service revenue fast enough to, firstly, justify the market's current optimism baked into the stock price, and secondly, generate the FCF needed to manage that debt load and navigate the 2028 refinancing.
So success means?
Success means hitting or exceeding that incredible 67.4% expected EPS growth over the next 3 years. It means successfully dominating a high-margin global niche market. It means deleveraging significantly.
And failure means?
Failure means that substantial leverage, the $833 million in debt, acts as a brutal magnifier. Any significant delay in product deployment, any unexpected spike in interest rates impacting that unhedged debt, or, say, a really negative outcome in that billion-dollar SmartSky litigation, any of those could severely jeopardize their ability to execute the plan and manage the debt. The downside is significant.
Okay, a stark choice for potential investors. And just to leave our listener with one final provocative thought, Gogo, through its accounting, has already made a kind of commitment that really asks you, the investor, to bet entirely on their future success materializing.
That's a great point. Remember those net operating losses we talked about?
Yeah.
And the deferred tax assets related to them?
Right, the $363 million in NOLs.
Well, back in 2023, Gogo released a valuation allowance against a significant portion of its deferred tax assets, about $72.8 million worth. Now, that release was a non-cash accounting decision. It boosted GAAP earnings at the time, but it wasn't actual cash generated.
What did it signify?
It signified management's stated belief, based on their internal